Good evening, everybody. My name is Sandeep Bhosle. I head the customer interaction team at Quantum Mutual Fund. Warm welcome to all of you for today's webinar. Thank you for joining us. Yeah, today we will be talking about and discussing about are the equity markets poised for growth and how it's going to affect your portfolio. We'll have a short presentation for around half an hour, then we'll take all the question answers. You can type the question answers in the chat window. We have to speak our two eminent speakers with us. We have Chirag with us and we have Hitendra with us. Most of you must be knowing Chirag and Hitendra, but still I will still introduce them again. Now, Chirag is our Chief Investment Officer at Quantum AMC. He has more than around 17 years of experience. Chirag has also extensively traveled and he has been involved in sustainable investing since 2015. He currently manages our 4 funds, largely in the field of alternatives, gold savings fund, multi-asset fund, equity fund of fund, and the ESG fund. He joined Quantum Mutual in 2006. We have also Hitendra Parekh with us. Hitendra has around close to 3 decades of experience. He is the fund manager for Nifty ETF. He's also the fund manager for our newly launched fund, Quantum Equity Nifty ETF Fund of Fund. We launched this fund on 18th. It's an NFO, it's an open. Yeah. So over to you, Chirag.
Sure. Thank you, Sandeep, and good evening, everyone. Thank you for logging in today. We're going to talk about where equity markets are, where they're likely to go, and how you could participate in this equity market that we see growing for next 2-3 years. So with that background, so if you look at today's equity markets, we've seen a good decline from where they were end of last year. And from there, we have seen some nervousness in equity markets, and therefore, which is reflected in prices as well. So what caused that nervousness really was global inflation going significantly higher. We saw already there were signs of inflation that got exacerbated by the war in Russia, Ukraine, and that led to commodities, including food and energy, going higher. That higher inflation compelled central banks across the world to kind of increase interest rates. Also, when we see that interest rates kind of move up, there is outflows by foreign investors from emerging market kind of economies back to the developed markets to take advantage of the higher yield it offers. And we saw that also because of inflation was very well entrenched and across the commodity complex, be it industrial metal, be it energy. That led to impact on corporate profitability because eventually these are input costs for them, and therefore profitability takes a hit. So equity markets saw a good decline from the secular run that we saw post-COVID. 2020 was after the COVID period, we saw markets moving higher. But again, there was some correction that we saw because of the global reasons, especially inflation and rising interest rates. Given that nervousness and rising interest rate environment, the foreign investors pulled out significant amounts of money from Indian markets. If you look at this year, they pulled out $28 billion from Indian equity markets. If you look at 2008, they pulled out close to $12 billion from equity markets, and markets fell by $60 billion. Because in that year, domestic investors was just $3 billion. If you fast forward it to this year, domestic investors were $30 billion, and that led to markets only falling by 9%. So the FI outflows were well countered by domestic buying. Indian investors across, if you look at in India, are significantly underallocated to equities, and they have been increasing their exposure to equities over the last few years. And this year, they have been a significant buyer. So though FII money was moving out, domestic investors were buying in. So at one point, FIIs have been pretty nervous and they're kind of pulling out, whereas domestic investors are using this decline to build in their allocation. And if you look at the corporate profitability, has been rising significantly over the last few years, especially post the COVID period. We have seen remarkable improvement in the ground level activity, which is translating into higher revenues for companies and therefore higher profitability. So if you look at the blue line on the chart, it is the net sales of companies And if you look at the gray line, it is the profit after tax of companies. So both have been inching higher. If you look at the period prior to 2050, from 2015 to 2019, it was flattish. If you look at the sales and profit, and therefore when we kind of communicated with you, we said that markets are not looking good because ground level activity isn't there, and therefore we were not so bullish on markets in that period. But now, post 2020, we have seen pickup in activity, translating into higher revenues, translating into higher profits for companies. And that is why we were kind of seeing that upside momentum. And it is kind of a period we think that will help India grow significantly. We are on the cusp of a good economic revival, which will continue for next 3-5 years kind of time frame. But near term, you may see that whatever inflation we have seen will lead to impact on profitability, maybe 1 quarter, 2 quarter, until and unless companies pass on the price increases to consumers. So as companies gradually pass on, they will get back to the normalized margins and therefore normalized profitability. And therefore, you may see the blue line inch higher, but the gray line may remain flattish and then over a period of time move higher. So that is how we see the corporate world kind of continue growing. Maybe there could be some dent for a couple of quarters. But if you look at now, things have really changed in last 1 month. If you look at inflation, what we were seeing a significant pressure, and because of rising commodity prices, we have seen a significant correction in commodity prices as well. So if you look at a broad commodity index has fallen by 16%, though year to date, it is still up by 19%. But last 1 month or so, we have seen a significant decline in commodity prices. Like, for example, agriculture commodity index has fallen by 23% from its peak. The crude oil prices have fallen 22% from its peak. The industrial metals like copper, aluminum, etc., have seen a bigger decline from its peak. They have fallen by 56% from its peak. So even year to date, it has taken them down negative, whereas agriculture, Brent, etc., oil prices are still positive year to date, but seeing meaningful declines in last 1 month or so from its peak. What does it translate into? Inflation kind of trend lower. One is because of base effect. B is because the commodity prices have been falling. So you will see, as you see on the chart on the right hand side, the blue line may remain elevated for some more time because of the secondary pass-through that happens, the second round inflation, as we call it, because of the input cost pressures, companies are increasing prices gradually. Could be some pressure on wages that could keep inflation sticky for some time, but eventually drop down. That is what you see in both the charts, both the lines dropping down because there will be gradual decline in commodity prices. Also, one important barometer that could have an impact on inflation is agricultural output. And you are seeing good, the monsoon has caught up well, and that has led to catch up on the sowing of kharif crops. And that will ensure, if we have a good agricultural output because of good monsoon and timely monsoon and good spatial distribution, then we will have good agricultural output leading to further fall in inflation. So inflation has been elevated, may stay for some time, but gradually move down from here on. So if you look at the blue line on the chart on the left-hand side is inflation. Inflation has been high, which is compelling central banks across the globe and even the RBI in India to increase interest rates. So if you look at the orange line is well below the inflation line, which means we have negative interest rates on the policy rate level. That's the repo rate, that's the RBI rate. And so gradually we may see further increase in interest rates from the Reserve Bank. But that's not a thing to be worried about, because much of that increase in interest rates that's going to come is already priced in the market. So if you look at the green line on the chart, the 10-year GSEC yield is already at higher level. It's already at 740 kind of levels today. which tells you that much of the increases have already been priced in by markets. And if you look at the table on the right-hand side, whenever we have seen interest rate increases, given that markets are forward-looking, they kind of try to price in much earlier. And if you look at the returns in each of the periods when interest rates were increased have been positive. So it's not that, once the interest rates start increasing, markets will kind of try to price in and therefore have negative returns. Markets price it on early, and therefore the returns mostly that we have seen during the hiking period have been positive. But having said that, seen that background, that what was impacting markets, inflation was the biggest cause of that. And now we are seeing some cool off in inflation pressures. So if that remains well behaved, then markets will have lesser things to worry about and will focus more on the growth levers of the economy. So what are the growth levers of the economy that we're seeing in today? One of the biggest delta that we are seeing is pickup in hiring in IT companies. And if you look at IT jobs, these are better paying jobs, and therefore, the spending power of people employed by these IT companies is significantly large. And if you look at the current hiring of these IT companies is at like 2 standard deviations above what we have seen before. And therefore, that significant level of hiring that these companies are doing will have multiplier effect on the economy, because when people get into well-paying jobs, they'll buy houses, they'll buy cars, they'll buy two-wheelers, they will consume more services, and that leads to more growth in the economy. Second lever that we are seeing is the residential real estate activity picking up. The real estate market is back, and one of the important reasons for that market revival is the affordability ratio increasing significantly. So if you look at the EMI to income ratio is at best that we have seen over the last 20 years. Although with rising interest rates, the interest rates may inch higher, but that will not going to significantly dent the affordability ratio. So it may still remain low as compared to what we have seen historically over the last 10 years. So that is boosting real estate demand in the economy. And if you look at the housing trend, the right-hand side chart, there has been significantly pick up in sales of housing units. There has been small decline, but it could be seasonality, or it could be because we have seen a good run up. There could be some cool off. But looking at the levers like IT hiring, jobs, etc., the housing activity is likely to increase, and especially because of affordability still remaining better, that will push the housing sales. Third important lever is robust tax collections. So if you look at the GST collections, the direct tax, indirect tax, corporate income taxes, etc., all have been inching higher. So that will provide the government the bandwidth to ensure there is more capital expenditure by them. And that is one thing also that could revive the economy. Usually, capex spending kind of helps economy do better. Private capex has been missing for last few years, barring some commodity producers because of the cycle that they have seen. They have started investing. But if you look at otherwise, capex was missing. But now with this government trying to pull the economy after doldrums or trying to ensure the growth momentum continues, there will the capex capital expenditure by them will lead to further improvement in economy, and therefore pull private capex at some point in time. So the economy, the headwinds that we're seeing because of inflation has been cooled down for now, or seeing some improvement because of cooling of inflation pressures. There are levers for the economy. Now, where are we on the valuation front? So if you look at the long-term average, the long-term PE ratio of markets is at 19.7. We are at close to 21. So markets have come off from the highs to reasonable levels, very close to the average level that we have seen over the last 20 years. So that really tells you that markets are not in that expensive zone that they were, but they're very close to the average valuation levels. Any decline from here will again see, there will be a great opportunity, because that will make markets even cheaper than what they have been on average. So from a market standpoint, it's good time if you're buying near the average or below the average. It's a good time to allocate to markets, especially when we are seeing earnings growth. So if you look at the right hand side table where you see the fiscal year 22 numbers, this is the first year out of last many years where we have seen the consensus estimates lag the actuals. So if you look at the start of the year, the analysts on the street were predicting earnings of Sensex at 2291, but actual came out to be 2321. All these years before, they predicted a higher number and the actual number came much lower. So if you look at, that is why we were not so bullish, because markets were running on hope. Now they are lagging what the actual reality is, because they have been wrong for all these years. They may be shy to say that, earnings growth is now coming through. But we think, given the levers that we have, given the cooling of inflation that we have, if it sustains, the actual earnings could be much higher than what the streets predict. And therefore, markets may continue to be supported because of the earnings growth coming through. So given that all that scenario, what could go wrong? What are the risks to the recovery that we are seeing today? If inflation continues to move higher again, that could impact mainly the SME companies, the small and medium enterprises. And if they are not growing well, that may lead to lesser jobs and therefore may impact consumer discretionary spend. Also, what we are seeing in Russia, Ukraine today, if that war extends and leads to more disruption on the supply chain, that could push commodity prices higher. Third, weaker than expected monsoon and therefore bad agricultural output could also create more problems on the inflationary front, and therefore again have an issue. Fourth most important risk, it's not only a near-term risk, but even a longer-term risk. India needs to create a lot of jobs. So if you look at until 2025, India needs to create 42 million jobs, which is more than 28,000 jobs per day over next 3 years to be able to absorb the educated people coming into the workforce. We have always highlighted this as being a bigger risk for India, because all these educated people come out of colleges and don't end up having good jobs. There could be a social chaos at our hands, and therefore it may be a big dent to the growth outlook. So government has to focus on creating these jobs for the people who are going to land out of colleges and look for good paying jobs. Also, if you look at over a longer period until 2055, India needs to create 136 million jobs, which translates into more than 10,000 jobs per day. So near term, it's a significantly larger problem. Even on the longer term, it is a bigger problem to be focused on, because so many jobs to be created, it's not an easy task. So with that equity outlook, with that risk in mind, equities as an important allocation of your portfolio is very, very essential. And it does translate into meaningful returns, giving you that edge over inflation, or the real inflation that we see as consumers or as investors, so that it helps increase our standard of living. So if inflation on a real basis is say 9-10%, you need to have returns which are over and above that. And equity is that one asset class that will help you achieve that higher return, and therefore not only meet your financial goals, but help you improve your standard of living. So if you look at since 1980s, last 40 years, India has grown at a real GDP growth rate of 6.1%. We believe that this rate of GDP real growth is not changing. We still think India will continue to grow at 6.5% real GDP growth rate for next 1-2 decades now, for next 10-20 years. We have seen so many things: single party government, coalition governments. We have seen assassinations, floods, droughts. We have seen all sort of things, but India has continued to grow at 6%. there are many estimates which will tell you that India can grow at 8, 9, 10%, but we don't think that's sustainably possible. There could be one-off years because given the consumption rates that we have, given the savings profile that we have, given the infrastructure that we have, we believe that growing at that 8, 9, 10% will be very difficult on a sustainable basis. But that 6.5% number is very, very achievable given the trends that we see. So with that 6.5% growth rate, what does it translate into returns for investors? So if India real GDP is growing at 6.5%, if inflation, which we believe is going to be at 5.5%, so let's consider 5%. So nominally, the GDP, the growth of the economy is real GDP plus inflation, which is 11.5%. So if economy is growing at 11.5%, the revenues companies at least will grow at 11.5% because GDP represents activity in the economy. Activity is nothing but sales of companies. And therefore, if GDP is equal to revenues, so revenues will be at 11.5%. If profit also grows in line with revenues, usually profit growth is higher than revenues because there are efficiencies that companies produce over a period of time. And therefore, the profit growth is usually higher than revenues. But assuming no efficiencies for these companies, and even if profit grows in line with revenues, that will translate to an 11.5% profit growth. And that's an average profit growth in the economy. So if you are a larger company, if you have a good brand, loyalty, etc., then you're growing faster than the average. And therefore, assuming that you are growing 2 percentage points faster than the average, the growth of these companies in terms of profit and revenues will be 13.5%. And if you're able to select even better companies, build an intelligent portfolio, then you could grow at 15%. So overall, the 6.5% GDP at least translates to about 13.5% growth for typical companies that constitute an index. Also, when you're looking at equity markets, generally, what we have seen that investors try to time the market, which we think that catching a top or catching a bottom is usually very, very difficult because we don't know when the low is in or when the top is made. So if you had invested at minimums at all points in time, you could have made a higher return. But given that it is difficult to predict, it is better to invest on an average and accumulate over a period of time, like the SIPs. Still, you generate a decent return. The return is 13% CAGR on a rolling basis, which is a good return to meet your financial goals, and of course a good return to surpass the inflationary pressures that we see on a real basis. So overall, don't try to time the market, invest regularly and earn that decent return, which will help you, because you might think that markets have bottomed, like what we clearly saw in 2008. Many investors thought in September, October, because markets started falling into January. And by September, October, people thought that markets have bottomed out, but it kind of fell significantly from there and bottomed only in March 2009. So it's very difficult to catch that bottom. So it's better to take advantage of the rupee cost averaging, invest at all levels, and build your allocation to achieve that respectable return that would help you for the long-term wealth creation. Also, what we have seen is that long-term investing is always better with that long-term horizon in mind, because if you look at 5, 7, 10 years, there have been no negative cycles on a rolling basis for Nifty. If you look at number of cycles where equities have given lower returns on your saving bank account has been 0. So the capital erosion kind of goes away if you have a longer term horizon. So on a 7-year, 10-year cycles, rolling cycles, we have not seen equity returns below that 4% level. And if you look at on an average over a rolling 3-year, 5-year, 7-year, 10-year, markets have given 14 to 15% return, which is good return. People try to time the market, and I will give you a good example. So if you look at on a 1-year basis, you could have on a rolling time period since 1999, you could have a maximum return of 97%, but at the same time, you could also have a possibility of having a negative return of 51%. So rather than having those two extremes, that 16% return is a good respectable return that you could have. So average out over a period of time, have a 7 to 10 year time horizon, and you can reap that average rolling returns that Nifty has generated, or 14, 15%, which is good return from any standpoint. Given that we understood the importance of equities, what trend that we are seeing today is because of the shocks that we saw in the economy, be it demonetization, GST, and then COVID. What we have seen is larger companies are getting larger. So if you look at the sales growth of top 30% of companies versus bottom 30%, their sales growth have been far more positive, whereas for the bottom 30%, it's still even negative today. Also, if you look at the fixed asset growth for larger companies, it's still in the positive, and it's been in the positive since 2017, 2018. Whereas if you see the bottom 30% companies, they have been struggling for fixed asset growth, and it's been in the negative. So larger companies have, grown larger because of these shocks that we saw, and therefore being in the large cap today is far more beneficial than looking at the mid cap and small cap space. So with that, though equities are a good asset class, but you need to remember that you need to diversify across asset classes. And this 12, 20, 80 asset allocation strategy, which means that 12 months money keep very, very safe. You could use a liquid fund that does not take credit risk, or anything where you think it's very, very safe. And after that, any money that you have can be split 80 into equities and 20 into gold. This suggested allocation has worked very well in different timeframes, be it the COVID crisis, be it the taper tantrums of 2013, be it the global financial crisis of 2008. It has worked during the ups and down cycles of market to run on a reasonable set of returns for investors while lowering the risk profile. So we would urge that you look at 12, 20, 80. The allocation strategy is there on our website for you to check. And if you think that 12 months is not enough for you, you need to have 24, 36 months of money kept safe as expenses. You could even try that. So you could tweak it to your requirement, but the message here is to diversify across asset classes. And you could start with 12, 20, 80 and tweak it to your requirements. 12, 20, 80 allocation can be achieved in two ways. So you would have seen before that, either you could do active allocation where the equity block could be the quantum equity fund of funds, the quantum ESG fund, and the quantum long-term equity value fund. Our objective is to give you those building blocks through which you can create your own asset allocation the way you want it. So in the 12 to 20, 80, you could have two choices. Either you build it the active way through the active funds, or you could build it the passive way through passive funds. So in the active, you have the active funds offered by Quantum, and in the passive space, you could use, say, Nifty allocation as a replacement for the quantum equity fund of funds and the quantum long-term equity value fund. So on our website, when you go, you have that option at the very top where you could use the active or the passive way to build your allocation. When you're going the passive way, you need to understand what you get and what you don't get. So if you're going in the passive way, of course, the passive costs are low. So there are lower expenses than the active. You get diversification because it's an index which is diversified. There is consistency because the fund manager kind of just follows that index and gives you that market-linked returns. What you don't get is an active managed portfolio. The fund manager's discretion and the potential to make alpha over the long run. So when you're trying to create that 12, 20, 80, as I've said, you get the choice of active versus passive. And if you're doing it the passive way, then the 80% equity can be built through just two funds, 85% of that 80% in the Quantum Nifty 50 ETF fund of funds, which is the fund that we have just launched, and 15% in the Quantum India ESG equity fund. So broad exposures of the quantum equity fund of funds and quantum long-term equity fund are replaced by the quantum Nifty 50 ETF if you want to go the passive way. And given that ESG is an essential allocation, you could retain that allocation to the Quantum India ESG equity fund. So why, when you're going through the passive way, you have three options. Either you can build the core allocation in Nifty through an ETF, through an index fund, or through a fund of fund that invests in the Nifty 50 ETF. What we are trying to do at one end, ETFs are very, very convenient vehicles. At the other end, investors want the convenience of an index fund. The fund of fund marries the two and gives you best of both worlds. Given the fund of fund invest in the ETF, you get the efficiency of the ETF. And in the fund of fund, you can transact like a mutual fund. So it gives you the convenience of the mutual fund. So with the fund of fund, of course, many people would say that, there is a underlying TER of the ETF plus the underlying TER of the fund of funds. But if you look at the price that you are paying for convenience is a very small price, plus the fund of fund does not charge any management fee to you. It just charges the scheme running expenses. So overall, your costs are not big over and above the fees of the ETF. Whereas if you look at most index funds are significantly higher priced. So you're getting that efficiency and the convenience at not a very higher level of expenses. So it's just an incremental cost you pay. So for example, the Nifty ETF is priced at 9 basis points. The fund of fund is priced at 6 basis points. You will be paying just 15 basis points. Whereas if you see the fund TERs of most index funds, they may usually be higher than what you will pay combined for the fund of funds. So with that, I'm happy to announce that the Quantum Nifty ETF fund of fund is the newly fund that we have launched. It is the India's first and only fund of fund that invests in a Nifty 50 ETF. So how it works is it's like a wrapper around the Nifty 50 ETF. So Nifty 50 ETF fund of fund invests in the Quantum Nifty 50 ETF, and Nifty 50 ETF invests in the 50 stocks constituting the Nifty 50. So you're getting the efficiency of tracking that Nifty 50 stocks by investing like a mutual fund, and therefore you get efficiency and the convenience both at the same time. So with that, I will introduce you to Hitendra Parekh, who is the fund manager of the Quantum Nifty 50 ETF and also of the newly launched fund, which is Nifty 50 ETF fund of funds. Hitendra has close to 30 years of track record in Indian equity markets. He has been tracking this fund or managing the Nifty 50 ETF since last 14 years, since its inception. So with that, I will hand it over to Hitendra.
Thank you, Chirag. And as Chirag has said, I'm managing Quantum Nifty 50 ETF since 2008, and I will be also managing Quantum Nifty 50 ETF fund of fund, the newly funds for which NFO is going on, and it will be closing on 1st of August 2022. You must be thinking that why we have preferred Nifty 50 to passively manage both of our funds. So just to have a look on the Nifty 50 index, we know that this index is one of the prime index of India as well as National Stock Exchange. This index have 50 constituents, and this index consists of all these 50 constituents consist of blue chip stocks of Indian economy. This index again represents majority of Indian sectors, so very well diversified. And this index is calculated based on the free float market capitalization method. And one more thing, this index is having history of wealth creations for investors over last 20 years. So if you look at the constituents of the index, it represents majority of large company of India like Reliance, HDFC Bank, Infosys, Kotak, ITC, and so on. As I told you earlier, also, this index is very well diversified. If you look at the sector-wise representation, the financial service sectors, that is the banking and real estate, have the weight of 35.10%. The second one is IT sectors, which is having 15.9. So if you go through the sectors which are represented by the Nifty, it is quite well diversified. And on stock basis, if you look at the Reliance Industries, he's having around 12.94% of the weight. HDFC Bank is having 8.55% and Infosys 7.73%. So there is a very good diversification at stock level also. And if you look at the 10th largest stock of the Nifty is L&T, which is having weight of 2.72%. So as we told, we are repeatedly telling you that Nifty is having a very good history of wealth creation. And this can be also seen in this graph. This graph is plotted since 1996. And during this period, we have seen three major crises. One is dot-com crisis in 2000. Another one is subprime crisis in 2008. And recently we have seen COVID pandemic crisis in 2020. So if you look at this crisis, Nifty has no doubt sharply reacted to the crisis, and there was a very good fall during this crisis when this crisis have broken out. But if you look at the Nifty has captured whatever gain he has faced due to this crisis in subsequently, and it has actually gone beyond this in very few years. So it has captured the loss in short terms and given positive returns going further. Now coming to the Quantum Nifty 50 ETF funds, which I am managing since July 2008. This is an exchange traded fund, and as you must be aware that exchange traded funds are traded on exchange during the market hours, and they generally trade at fair value or real-time NAV. And you can buy these exchange traded funds just like any other stocks, listed stocks, which you are buying on exchange. This product is useful for the investors who are looking at long-term capital appreciations. Now, other features of this fund is this Quantum Nifty 50 ETF is 1 unit of Quantum Nifty ETF represents 1/10 of the Nifty value plus accumulated dividend plus dividend which we have accumulated since inception. So if suppose currently the Nifty is say 1700, the value of the Nifty 50 ETF would be 1700 plus accumulated dividend which we have accumulated, the dividend which we have accumulated during this period. Now the performance of this fund is in line with the index, and there is a subject to the tracking error and expense ratio. This fund is charging 0.09% expense ratio. Now, as I told you earlier also, by investing in these funds, you get the exposures in 50 companies, and these 50 companies represent majority of sectors of Indian economy. This is a passively managed funds, and if you look at the tracking error of this fund, it is 0.168% since inception. So according to me, this is very closely tracking I'm very closely tracking the funds. Now this graphs plotted on three securities. One is Quantum Nifty 50 ETF. Another one is Nifty 50 Total Return Index, which is the benchmark for my fund. And the additional benchmark is S&P BSE Sensex Total Return Index. And you can see that since inception of this fund, that is July 2008, you can hardly find that either of these securities has deviated from each other. So all these three securities are moving in line with each other. So that shows that how closely I'm tracking the underlying or the benchmark, that is that is Nifty 50 Total Return Index. Now, just to tell you about the performance of these funds, this fund has given on yearly basis, during last 1 year, this fund has given return of 1.59% against the benchmark return of 1.66%. So, and as I told you earlier, I am charging 0.94% expense ratio to manage this fund. So if you gross up the expense ratio, this fund has generated return of 1.68% against the benchmark return of 1.66%. Now look at the inception return. Since inception, the fund has given return of 11.29% against the benchmark return of 11.34. So there is a underperformance of around 5 basis points. That is because of the tracking error, and that is also because of the expense ratio, which we are charging to the funds. Now, just to highlight to you that if suppose you would have invested 10,000 rupees since inception, on inception of this fund, then as of 30th of June, it would have become 44,619 rupees against the Nifty value, which would have become 44,927. So there is a difference of around 300 plus rupees. That means this fund has closely generated the returns as close to Nifty, and there is a lesser return of around 300 rupees. That means that that the fund is very cheap, and the quantum mutual fund has charged only 300 plus rupees to manage your 10,000 rupees over a 14 years. If suppose you would have tried the same thing, if you would have tried investing 10,000 rupees in 2008 and try to match the Nifty as of today, then there are at least 14 instances where the Nifty exchange it constitutes. And you know that how much you would have paid as a brokerage and price impact for rebalancing your portfolio. So again, just to highlight that, you for managing your 10,000 rupees for 14 years, you would have paid around 300 plus rupees to the quantum mutual fund, but it has generated a very good returns to you. Now, as Chirag has also mentioned, and you are also aware that we have launched Quantum Nifty 50 ETF fund of fund, and the NFO is ongoing, and it will be closing on August 1st, 2022. This is an open-ended funds, and it will be investing in Quantum Nifty 50 ETF to track the Nifty 50 Total Return Index. And as already I highlighted that by investing 500 rupees in these funds, minimum 500 rupees in these funds, you get the exposures in Nifty 50 companies, and there is no upper limit of investment in these funds. Now you must be thinking that when we have ETF, then why we are coming out with the fund of fund? Chirag has also spoke on that, but I would like to highlight further on this, that in case of ETF, there is no SIP options available to you. Whereas if you are investing in fund of funds, you get the SIP options. And you are aware, SIP is the systematic investment plans. by giving one-time instructions to your fund house, you can keep the fund house will keep investing on your behalf according to your instructions. So just to give you example over here, if suppose you want to invest say 10,000 rupees on 10th of every month for next 3 years, then if you are an investors of ETF, then every month on 10th, you have to go to the exchange side and execute your orders. But if suppose you are investors of fund, you just give instructions to your fund house, that is quantum mutual funds, once only, that I want to invest 10,000 on 10th of every month for next 3 years, and your instructions will be executed periodically by the quantum mutual funds. Now again, coming to ETF, in case of ETF, if you want to transact, you need to have Demat account as well as broking account, whereas the investors of fund need not have to do either of these two. They can directly approach the fund house and invest. Now, when you are transacting on ETFs, you have to pay brokerage and other charges to the brokers. This is again not required in fund of funds. So because of these benefits, we have introduced fund of fund, which is again which will be investing in quantum Nifty 50 ETFs to give you the returns in line with the benchmark returns, less of expense ratio and tracking error. Some of the silent features of this fund of fund. This is a passively managed funds. This tracks Nifty 50 returns. There are 2 plans available. One is regular plan and one is direct plans. And both these plans have the growth options. There is no exit loads, entry loads or exit loads to the investors. Now on taxation front, the fund is categorized as an equity fund, and taxation will be applicable just like a any other equity fund. So no need to worry on taxation front also. Look, and on expense ratio, the fund charges 0.06% as expense ratio directly, and since it will be investing in quantum Nifty ETF, where the 0.094% expense ratio is charged. So for a direct investors, the expense ratio would be 0.15%. If you look at the other alternative available to you in the market, like index funds, you will find it will be far cheaper than the many of the index funds. Now coming to the regular plan expense ratio, the fund will be charging 0.18% expense ratio in a regular plan, whereas underlying fund, and the underlying fund is charging 0.09% as the expense ratio. To the regular investors, the expense ratio would be 0.274%. Now, as we are talking about the passive investment strategy, and as you know that this investment strategy is quite efficient and convenient. Generally, the passive fund managers take the benchmark on underlying index very closely, and his main objective is to not to outperform the benchmark, but to give return in line with the benchmark. Here, the fund manager does not have any discretion. He has to invest in the funds, in all the constituents of the underlying funds which he is tracking, and also to the extent of the weight of that particular stocks in the index. Again, just to highlight that index are generally well diversified. If it is broad-based index, as I told you earlier, Nifty, take the example of Nifty, you get the exposures of sector levels exposure also you get, and you also get the company level exposures. But if it is a sectoral index, there are a lot of constituents, and so you get within a sector's exposures across the many constituents of that index. Yes, Chirag has already told you about our 12, 20, 80 passive allocation. Just to highlight that, Quantum has always suggested its investors on asset allocation strategy, and this 12-20 asset allocation strategy is times tested asset allocation strategy. And here we suggest to the investor that you keep around 12 months of your expenses, whether it is a household expenses or it is an entertainment expenses, or whether it is a medical expenses aside, and after that what are balance amounts available to you, you invest that you balance amounts you invest in the financial securities, and within these 20% you invest in gold and 80% in equity. Thank you from my side. And now we are happy to take any questions if you have. Over to Sandeep.
Thanks, Hitendra. Thanks, Chirag, for the brief presentation. We do have questions. We do have some questions in the chat box, and some existing investors also have written to us. They would like to take some. So, over to you, Chirag. The first question, Chirag, would like to know your views on the overall global market scene right now. When do you see this volatility settling down? People have investments. The investor has investments across multiple mutual funds, and which is affecting his portfolio. So, what are your views on this?
So overall, as we mentioned that, global markets are witnessing that dual pressure of inflation and therefore higher interest rate environment and tightening environment that we are seeing as a stance from central banks. So overall, global markets will remain kind of volatile until these two things subside or get priced in by markets. But on the inflation front, we have seen some cool off happening. Whether it sustains or not is difficult to say unless there is kind of a shock that further worsens the scenario. Inflation will likely subside from here on. And if you look at, but within the global markets, India is still very well positioned today. So if you look at one of the big things that hampered global markets was also inflation on energy and agri. Energy, Indian markets were also impacted because we import all of our crude oil requirements. But on the agri front, we were relatively shielded because India is a top producer in many of the agricultural commodities and does have a huge amount of buffer stocks. So that helped India shield away from the input pressures on the agricultural front. So the kind of impact of inflation that the developed markets have witnessed, to give an example, the inflation in US market on an average for last 10 years was 3% at the max. It used to be between 1 and 3%, and they had not seen inflation above 3% for last 10 years. But if you look at now, inflation is at 9% in the US. Whereas if you look at Indian history, we have seen inflation between the 3-4% on the lower side to about 9-10% on the higher side. We are at close to 7-8% inflation. So we have been through this kind of phase before. Indian consumers have seen this kind of inflation. Indian companies have seen this kind of inflationary pressures. So it's not new for Indian companies, and therefore they have been able to manage this inflation phase much better than what we have seen in the global markets. So overall, looking at the structure that we have today, one is inflation pressure subsiding. Indian central bank may not have to raise as much to tackle inflation as US or other developed market would have to. So from that perspective, also India is better off. And we have a good structural growth story going for us. We think that India is on a cusp of an economic revival, which is likely to continue, may get delayed by a quarter or two because of the inflation that we're seeing. But even post that, we are good on the economy front. So from that perspective, I think it's time, given where valuations have come down, the growth story remaining intact, inflation subsiding, I think it's a good time to allocate and build your equity allocation if you're under allocated to equities. If you don't have that desired 80% allocation to equities within the 12, 20, 80, then probably this is a good time to increase your allocation. So I think take advantage of the declines that we are seeing or any other further decline that we may see. Or else the time-tested way to keep allocating at all points in time will be a great strategy to continue with our systematic investment plans. So I think don't get nervous. I think these kind of opportunities we have seen time and again are great to allocate to Indian equities. And this time is no different given the levers that we see for the economy.
Thanks, Chirag. Chirag, taking the question ahead, same question on quantum long-term equity fund. Now, quantum long-term equity fund, this is a question from our investor, Mr. Satish. Quantum long-term equity fund, value fund returns are in single digit. He says from 5 to 10 years. He wants to ask that there's a suggestion also for a double-digit return. Would it be fine to increase the current stock levels from 30 to 50 or something to good value stocks? Can you please comment on that? And just also for information, I'll add the 10-year returns for quantum long-term equity funds has been around 13.02 and 3 years has been around 11.82. So the question the investor wants to ask is that whether increasing the stocks from 30 to 50 or 60 to good value stocks, will it help out? Your comments on that.
So firstly, I want to reflect back on what we have always suggested to asset allocate and diversify. So we have said that investors need to allocate to the value style, but ensure that that allocation is 15% of that 80% that you allocate to equities. So if you have done that, I think you are broadly diversified. This is because each and every style will go through a cycle of its own. So until 2016, the value fund was doing very well. Post 2016, what we saw is the growth stocks kind of took over because the scenario that we were in, where central banks were keeping rates low, were pumping in a lot of liquidity, and that ensured that risk was not getting priced in adequately. And therefore, the growth stocks did really well, and value stocks were not being chased after in that kind of market scenario. So from 2017 till 2020, till the COVID crisis, value as a style, not only in India, but globally did not do well. Because the scenario, economic environment was such, there was plentiful liquidity and liquidity was just chasing growth. It was flowing to each and every corner where there was growth being offered. And therefore, value as a style took a back seat. Post 2020, because of the risk that we saw to the economy, I think some rationality came back to the market. And value style again started coming in favor. And especially now, this year, when we are seeing that inflationary pressures in the economy, which is leading to central banks tighten liquidity, increase interest rates, and therefore there is now been rationality to the way risk is being assessed in the economy. So overall, risk is now well being assessed, and you look at the value funds performance this year vis-a-vis growth stocks, vis-a-vis the indexes, it's been far, far superior. And again, that's not only in India, that is evident globally, and it's also evident in the performance of the quantum long-term equity value fund. So every investor needs to understand that each and every style goes through a cycle of its own, and therefore you need to diversify across styles. And given that low return was because that style was out of favor, but if you see the return since 2020, post the COVID crisis, when risk is being assessed rationally by markets, you are seeing that performance come back of the value style. And we think that value as a style will do well because the scenario that we are in is not changing anytime soon. We think that inflation may cool off a bit, but inflation to some extent may remain sticky. Also that given central banks are behind the curve because inflation is at a high level and interest rates are low level, they need to ensure that interest rates move up so that savers get a real return, and therefore, over a period of time, inflation cools down. So interest rates will go up, liquidity will be pulled out by the central banks, and therefore value as a style will do well because risk will be assessed and markets will be more rational now. So if you are under allocated to value as a style, don't try to time these style cycles. Rather be allocated because don't know which kind of time, which style will come in favor, and therefore always diversify across styles. And I think value style is now coming back in favor. So what disappointment that we have seen from 2017 to 2020 was because things were not right for the value style. And now it is, and therefore you're seeing that performance come back. Like you mentioned, Sandeep, that 3-year track record is now in double digits as opposed to what it was earlier. So that is because value doing well, and therefore the quantum long-term equity value fund also doing well.
Thanks, Chirag. Another question. This is from our investor Madhusudan. Now, given the fact that as per our own words, we are not asset gatherers. Now, how confident Quantum AMC is in collecting the 10 crore AUM set by SEBI? And don't we feel that are we a late entrant in the index fund? How are we going to attract the investors' confidence? So, any comments on that, Chirag?
Sure, Sandeep. So I will again reiterate that point. We are not asset gatherers. What we are intending to do by launching this fund is to give investors that building blocks to complete their asset allocation, because we believe that asset allocation is paramount. It is very, very important for investors to allocate at the different asset classes. So whatever the investor preference be to select the underlying building blocks to build that asset allocation, we want to give them and arm them with that choices that they were looking for. So this is just a further stance as an investor first fund house to give them that building blocks, and therefore whatever their preference be, active or passive, they need to use these building blocks and build their asset allocation. So again, we are not asset gatherers, but again, working in the interest of investors to give them that arms and ammunition to build their asset allocation framework. In terms of the Nifty 50 in ETF fund of fund, it is the first of its kind, because by structure, the index funds are not efficient vehicles. Because say today, to replicate the 50 stocks of the Nifty, we will require a minimum of 20 lakh rupees. If an index fund at any point in time, given these are open-ended funds, at any point in time, they get lesser than 20 lakhs, the money may stay idle in the fund and therefore reduce their ability to track the index. Whereas in a Nifty ETF fund of fund, it is giving you that efficiency of the ETF and therefore being more efficient to track that. So in a Nifty 50 ETF fund of fund, even if the fund gets 2,000 rupees, it can deploy in the underlying Nifty 50 ETF and therefore track markets very well, because the cash will remain very, very low percentage of the portfolio. Therefore, we are not late. Rather, we have devised a fund which marries the best of both worlds, giving you that efficiency and the convenience of the index fund into a one fund, which is the Nifty 50 ETF fund of fund. So we are very confident because we have always put investor first and see what is essential for them, what is beneficial for them, and give them that right product rather than trying to be the first. So this is again our attempt, and we are confident that all those who want to build that asset allocation the passive way will choose this as an asset allocation framework or a core portion of the allocation and sign checks for 5-10 years to build their asset allocation and build their equity allocation over a period of time.
Thanks, Chirag. There's a question for Hitendra, one of our investors would like to start a SIP in Nifty 50 ETF fund of fund. How long do you think this should continue? He should continue investing in the SIP. His age is around 35 right now.
If you look at the, as we have seen the history of Nifty, Nifty has given very good return over a period of time, even though they are in between, there are any crisis which has broken out. So if suppose, now coming to his questions, at the age of, he's at the age of 35. So according to me, if suppose he is investing for 5-10 years, keeping horizon of 5-10 years, I think Nifty has given more than around 10% return on CAGR basis. So that will be a very good horizon of his investments.
Okay, thanks. Chirag, there's a question from an existing investor. I'm an active investor and would like to trust an expert like a fund manager to actively manage my money. Now, should I invest in this fund, or what would be your advice for? Now, I want to build a portfolio with the expertise of a fund manager. What are your comments?
No, surely do it by all means, because if you believe in active, you should go the active way. We think that Indian markets still have the potential to generate that alpha, given the efficiency in the market that prevails today. So I think if you choose an active, then you build the asset allocation the active way. Our motive was to give you that building blocks and go where your beliefs are. If you believe active, do it active. If you believe passive, you do it passive. So we are just giving you or arming you with the building blocks, and you could build it the way you want. So I think no harm in choosing an active fund manager and building it the active way.
Thanks, Chirag. Now, this is a question from Mr. Ajay, and this is also a question regarding Ajit, and we have Ajit today with us. In fact, I think Ajit himself can take his question. Hi, Ajit.
Hi, Sandeep. How are you? Hi, Chirag. Hi, Ethan. Hi, everyone.
Thanks for joining us, Ajit. Thanks, Lord.
I join, I think, all the quantum webinars, but I keep quiet. But here I saw many people have used my name, so I said maybe I should say a few words to explain things.
Great. It's a pleasure to have you, Ajit. Okay. So I think the question was the flagship fund for quantum is still underperforming. That is quantum long-term equity fund. This is a question from our existing investor, Mr. Ajay. It is still underperforming and no improvement there. All 15 years, he said, Ajit said that Bogle told him that he will not invest in index like Nifty. Now we have a index fund coming, and we have an index fund of fund. So would like to have your comments on that, Ajit.
So I think those are very good sort of things for me to clarify. I think you have to look at Ajit Dayal, the individual, and what an investor may want. And I think Ajit Dayal as an individual is still investing in the value fund, has invested in the quantum equity fund of funds, and has invested in the India ESG fund on the equity side. On the debt side, I've invested only in the liquid fund. I'm not an investor in the dynamic bond fund. I am an investor in the gold fund, and I am an investor in the multi-asset fund. And the reason I say this is because we've not designed quantum mutual fund for Ajit Dayal. We've designed quantum mutual fund not as a fund house, but as a place where you get solutions that make you happy. And many of you know that I had been writing a column called The Honest Truth for over a decade. And after the Lehman crisis 2008, I was on a holiday, and I wrote about the fact that I'm on a holiday. And one of the readers said, how dare you be on a holiday when the world markets are down and we're suffering? And that's when I realized that what I took for granted of asset allocation, people had not really understood it. And readers of The Honest Truth will remember that at the bottom of every article, I had a table where I had a suggested asset allocation for how they should invest their money in terms of breakup between equity and gold, and also keeping about some money which you would need for a rainy day, and not rainy day, sorry, for an urgent emergency purpose, which is in the liquid fund. And over the last decade, Quantum has consciously built a platform of different mutual funds, which you can access now. Chirag, do you mind going to that switch of the active passive where you had that slide of that switch, please, or the choice of the 12, 20. So we, this should have been launched in 2016, 2017. It is a fault of Quantum AMC that we did not showcase this in a very clear manner 5 years ago. And I'll answer all the questions by sort of talking about this, that what we have done in this tool, try to give you the power to decide what you want to do. And that doesn't mean that Ajit is necessarily going to do what you want to do. The first thing we ask you is, how much money do you actually have as your investment pool in that total planned investment? And then the next question is, what's your monthly expenses? And then the third point, where there's a default 12, is our suggestion to you that keep 12 months of your monthly expenses in really, really safe. So in terms of a pyramid, the base of the pyramid is the safest part of your money. And we have a diagram of I think we have a diagram of the pyramids, one ahead or one before. If you can just switch to that very briefly, Chirag. So the base of that pyramid is where you keep your safety money that you need. God knows if there's a COVID or a Lehman crisis, or Russia sends tanks into Germany, or maybe China sends troops into Arunachal Pradesh. We have no idea what's going to happen, or the interest rates in the world go sky high and the markets collapse. But that's the money that you have to survive for 12 months till the world stabilizes. And that 12 can be 24, 18, 6, whatever you want it to be. In my case, I know it's between 24 and 36. I generally tend to be risk averse, even though I'm an equity investor. And then the rest of the money that I have, that is the money which I keep, if you will, in that breakup of gold 20% and equity 80%. And within equity, we've given you the choices. If you, like Ajit Dayal, are a believer in active, you can put all your money in the active funds. And if you are not a believer in active, if you don't like the way values performed, or if you don't fully understand what value is about, and I think that's really what the problem is, and I'll come to that in a while, then you can switch to the Nifty fund. So we're not telling you that index is better. We're telling you, you decide what you want to do. We're happy to give you solutions that are transparent. We're happy to work with you to ensure that the allocations you make are sensible by giving you that very powerful, simple engine. Literally, you spend 3 minutes of your time on that engine, you'll have your asset allocation model. It'll also tell you what your expected rate of return is likely to be if you had been in that allocation since inception. And it'll certainly tell you what your costing is. So we show all our costs that are there for each of the, for each of the products. So it is not about us abandoning value. So let's get that first clear. If I can see some, comments on the chat group saying, yes, Ajit, we understand you're not abandoning value. Now I'll come to the value part and our performance and everything else, that we talk about on value and its track record. But I really want people to recognize that the Nifty is still an imperfect index. Hitendra said it's diversified. Yes and no. Reliance is 12% of the index, right? Financial services are a third of the index. Yes, financial services are a large part of the economy, but also Reliance, if you look at oil and gas, it was 14% of the index, and one stock, Reliance, is 12% of the 14. So it's not that well diversified across every single, sector. But overall, yes, it is diversified, right? Is it a perfect diversification? I don't know. Would I ever buy Reliance? Probably not in my lifetime, unless I see some change in the way the company is run. So it's not good for me to be an investor in the Nifty index in terms of conviction. I may do it to show support with quantum. And I think there was a query up there, like, will you reach your 10 crore target? Yes, I'll give some money. I don't have 10 crores to give, but yes, I will give some money to make sure that they do reach that minimum target of 10 crores, etc., etc. But I'd love to talk a bit about value, because that's a very difficult thing to explain, and it's more like a philosophy. Firstly, you should recognize there is no definition of what is value. It doesn't exist. You look up any textbook, there's no definition of value. And when I was working for Tom Hansberger was a co-founder of Templeton, Galbraith, and Hansberger, which is now known in the world as Franklin Templeton. Templeton Galbraith Hansberger was a value shop in equity. Franklin was a debt company in California. And these guys were based in Florida, Templeton Galbraith Hansberger. So the debt company bought over the equity company, Templeton Galbraith Hansberger, renamed it Franklin Templeton. And then they started their growth of asset gathering on the equity side worldwide using the Templeton framework. But the Templeton funds that you see, the Franklin Templeton funds you see today, are not the same as the Templeton funds that were set up by Sir John Templeton, John Galbraith, and Tom Hansberger. And I had the honor and the privilege and the joy and pleasure of working with Tom Hansberger in Florida. But his marketing guy told me decades ago, he said, Ajit, value lies in the eyes of the beholder. It's like beauty. Everyone's definition of beauty is different. It's the same thing with value. And it becomes very, very complicated to say that, you know, how am I comparing with a peer in the value group, right? Because there's no necessarily a peer in the value group. Everyone's got their own definitions. Our definition of value with values, keep that in mind, that's very important. Value is valuation metrics. Values is what today you call ESG. We started that in 1996. We started a very sort of rudimentary form of ESG, and we called it the integrity screen. And Reliance and SR and Vedanta have failed that integrity screen year after year, quarter after quarter, month after month for the last few decades. We don't own those stocks. Yes, we've given up returns, but that is not what we're after. We're after controlling risk. And risk is not the up and down movement of share prices. That's called volatility. Risk is suddenly finding out that the company in which you invested, maybe a Yes Bank or maybe a Reliance or whatever it may be, the fundamental reasons for your investment have been questioned and are proven to be false. And the share price collapses, as it has done in Satyam, as it's done in Unitech, as it's done in Yes, etc., etc., etc. So risk and value and values is what we do. I can tell you this, that there is no other fund house in India which has value with values. Is that good or is that bad? We don't know. There's a track record which you can compare with the Nifty, but the Nifty has Reliance in it. But we don't have it. Nifty may have Adani in it. We don't have it. That's not an excuse. It's a differentiation. If you're not worried about risk, the Nifty is a perfect place to be. If you want actively managed, yes, there's us as value managers, and there's other value managers, and there's small cap, and there's mid cap, and there's growth, and there's multi cap. And we've provided all of that to you in the equity fund of funds. Quantum could easily have paid distributors, and believe me, we'd be a far larger fund house in AUM terms if we had paid distributors money to collect assets, rather than saying, no, we must focus on the investor. We must must come out with solutions through various products that we have that make sense for the investor, and let the investor decide what he or she wishes to do. That's the platform we built. So if you are nervous about FDs, we built a multi-asset fund. The multi-asset fund, I can't remember the exact numbers, but I think 95 or 96% of the time, if you were an investor in it on a 3-year basis, your rolling basis, you made more money in the multi-asset fund than you did in a fixed deposit of a bank, and you had liquidity, right? In terms of what we're building with 12, 20, 80, imagine we're taking money into the equity fund of funds and we're giving it to other fund houses. We don't keep it for ourselves to manage and earn the fees. We're fanning it out to others. Why would we do that in a normal fund house to keep all the AUM in their own pocket so they can collect a high fee? We're doing this as solutions for y'all. That's the big distinction between us and any other AMC out there. So since you all mentioned my name, I was very keen to come and clarify a few thoughts and kind of point out a few things. And I'm glad you brought those out, because those need to be repeated, time and again, to remind ourselves and everyone that we still stand for what we stand. But most importantly, we stand for doing things that make sense for the investor, not only for Ajit Dayal and John Bogle. So those are my comments. If I missed out on any of your comments regarding me, more than happy to address those. Sorry, I've not put my camera on. I have a bit of a bad throat and cough, and I'm not dressed as smartly as Sandeep and Chirag and Hitendra. So apologies for that.
Thanks, Ajit. Thanks, Ajit. I think most of the questions in the chat box, you've taken it all together. Thanks for that.
Thank you.
Yeah, Chirag, one of our investors has been asking. He has been reading your views on gold and ESG. So, what is your outlook on equity markets now?
So equity markets, we like equity markets the way they are today. We think that Indian economy is on a cusp of an economic revival. We have seen that, valuations have corrected from where they were. So overall, I think the Indian equity markets are should do well over next 2, 3, 5 year timeframes. So overall, we are seeing growth levers in the economy. One is the IT sector doing well, or hiring by the IT companies at least has been on a strong footing. Real estate activity, which has multiplier effect, has been doing well or has been reviving after a long time. And thirdly, government, given the tax collections, has more levers to kind of undertake more capital expenditure. And at some point in time, we will see the revival of private capex, which will further drive the economic activity in the economy. So overall, I think as amongst various economies which are kind of underneath the pressure of inflation, Indian economy also has inflation, but I think we have dealt with such inflationary pressures before. And given the growth levers, I think we should be better off. So overall, I think there is more upside and lesser risk. Of course, risks are there. There could be anything that could go wrong from an inflation standpoint, or be it any kind of situation that could occur, or be it the bad monsoon, or we not able to generate enough jobs over the next 2, 3, 5 years. All those are risks, but overall, even considering those risks, we are kind of better off. But given the risk, of course, that asset allocation comes into play. And if you have that right, I think we are better off. And if you don't have that 80% allocated to equities, either you could do it now, given where we stand today from a valuation and upside standpoint, or you could build it over next 12 months, 24 months of your equity allocation.
Thanks, Chirag. Same question from the investor. He has written that he believes that quantum is a big believer in gold. So, but in the asset allocation, 20% gold seems very high. Why is it 20%? Why it cannot be 5 or 10%?
So if you look at, we did various studies, right, from 1990 till now. We kind of looked at portfolios which were, say, 95% equity, 5% gold, starting with 100% equity, then each 5% lowering of equity allocation and giving it to gold. So optimal allocation where your overall portfolio returns are not being compromised. You still get a slightly higher return than your 100% equity allocation and significantly lower risk. So at each 5% gold allocation, your risk kind of was coming down. And at that 15% point, it kind of optimized from a risk return standpoint. So if you take that 12 months of safe money, and if you were to split any money after that into 80-20, then overall, from an overall wealth standpoint, your gold allocation will be somewhere around that 15% mark. So overall, we think that 20% allocation after keeping that 12 months money is optimal level where we kind of saw that risk reward play favorably for gold. So overall, as a diversification tool, as a store of value, as a currency hedge, gold has performed its role well. So I think it deserves that 15% allocation from from a portfolio standpoint. And if you were to remove that, add that 12 months of safe money, eventually with that 20% allocation, your overall allocation to gold would eventually come to that 15%. So we are very comfortable, and there are hard numbers that tell that 80-20 allocation works really well, and therefore that 20% there.
So Chirag, there is a question again. How will Nifty 50 fit into my asset allocation? Should I keep on changing it or changing it? The investor is not an active, not a passive investor. He's a combination of both. It's a combination of both. There is some allocation he does into active, there is some allocation does in passive also. And our asset allocation says one is an active and one is an passive. So what would you comment on that?
Yeah, so what we are saying is, the suggested 12, 20, 80, one can customize it the way they want. And that is why what we are doing is giving them the building blocks. So one could either have a preference of either going the active way or the passive way, or even a combination where you know that overall allocation from your equity bucket has to be that 80% equity. So the way you want to build it, you can build it that way. We will give you those building blocks. And I think one should carve out and know what is the ideal allocation for a particular product within that 80% overall equity basket. So once you know that, it is easy to do it with the building blocks that we give. So it is just the way investor want it, they can build it that way.
Chirag, would you like to brief people about the other fund that we have filed for Vanguard? What is the status right now? We have filed for a product for international FOF. And
yeah,
how much
so we
allocation
have
you should
filed
have
for a
ideally?
product which is the Quantum Global Fund, which will invest in predominantly Vanguard funds. So it is a fund which will have an equity allocation, a smaller debt allocation, and a gold allocation. So we are also building that as a multi-asset. And that's useful for anyone who wants to build that dollar kitty for any purpose, be it for the children's education abroad or for any other foreign expenses. So they want a dollar exposure, they get that dollar exposure, and which is not taking that overt risk of just buying equity. So it is diversified in that sense and gives you that, a steady return. Diversification is for achieving that very steady return. So we filed, as you would see, we have filed that fund with SEBI and we are awaiting that approval. Once we get that approval, we will launch that fund.
And how much suggested allocation would you tell to the investors, or maybe we will soon come out with it?
So given that it is a mix of two things, right? One is giving you that global diversification. And also given that it's a global exposure, it also acts against or protects you against that rupee depreciation to an extent. So from that perspective, I think it will be a carve out from the equity bucket and from the gold bucket, because that allocation is predominantly equities with some debt and gold exposure to kind of diversify. And given it has also a bearing in terms of protecting from the rupee depreciation, which also is a role that gold does. So we will carve out something from there. So we will soon reach out to you with the suggested allocation, but again, it will be slight trim off from both the buckets, the 80% equity and the 20% gold. Those allocations may come down a bit to accommodate the global allocation.
Thanks. There's a question for you, Hitendra. Wouldn't it have been better that we would have launched a plain index fund and not a Nifty FOF product? So the expense ratio would have still come down, because the present fund of fund Nifty ETF has an underlying expense of 0.09 and then he has 0.06.
As we have seen, and Chirag has also spoken in our presentations, we have launched Nifty base or a wrapper fund to track Nifty 50 total return index by launching a fund of funds. Because if you are managing index funds, then whenever there is an inflow or outflow in the scheme, if it is if it is less than 20 lakhs of rupees, then it will be very difficult for me to replicate the index. Because if I want to replicate the index, then I need to have 20 lakhs rupees. So if suppose I'm managing index funds, then for me, replicating index is very difficult unless I get at least 20 lakhs of rupees inflow or outflow. But since I will be since we are launching fund of fund, so that even though if there is an inflow or outflow of say around 2000 rupees, which is the value of Nifty 50 ETF, I can easily replicate the Nifty index by investing in quantum Nifty ETFs. And now coming to expense ratio wise, if you look at the other index funds which are available in the market and you look at the expense ratio of the quantum Nifty ETF fund of fund, you can easily say that the Nifty 50 ETF is almost in line or cheaper as far as expense ratio is concerned. It is just 0.015%, 0.15%, including the expense ratio of underlying funds. So in a direct plan, and in indirect plan, it is 0.27%. So on expense ratio wise, it is quite cheap as compared to the other available funds in the markets on average basis.
Thanks.
Thank you.
Thanks, Hitendra. There's a question on considering long-term view. How is the succession planning being done at EMC level? Since this is a fund house, since we are a fund house with an over AUM comparatively, there may be some concern on longevity aspects.
Yes, so Sandeep, we are a very process-driven fund house. There are no star fund managers at Quantum. So each and every product is managed by a team and not by a single individual. So most of the active funds will either have at least 2 fund managers managing it, or there will be a set process, and also there will be a set process through how we manage. So even if someone were to leave, the fund will be exactly being managed in the same way as it was done prior to the fund manager leaving. So, so there are no risk as such. Plus, we ensure that all active funds, there are at least 2 people managing those funds. So there is, in a way, both things present. One is a team-based approach, a process-driven approach, and a succession plan for all the funds that we have.
Thanks, Chirag. The question with the RBI, now this is more of a economic, RBI not increasing the 7 billion mark. How soon do you see the global fund to be launched? There has been restrictions by SEBI on investments, on offshore investment. Now, how do you look forward to your global fund? Will it be coming soon, and when will be the regulations going off?
So the restriction that is there, or where there is not much headroom available, is where the funds invest in underlying stocks in the global markets. The fund that we are proposing is a fund that invests in the ETFs, and there is still headroom available for investing in ETFs. And therefore, once we get an approval, we will be able to launch, given that there is still headroom available for investing in ETFs, which is the underlying for our fund. So we will be investing in predominantly in Vanguard ETFs, and there is still scope in terms of headroom available on investing in ETF, because there is a separate allocation for that, which is $1 billion. And still the industry has not reached that allocation level. So again, it shouldn't be a hurdle for us whenever we receive an approval to launch that fund.
Thanks, Chirag. So Chirag, another question on this, on multi-asset fund. Any thought on adding global fund allocation within quantum multi-asset fund? And since this is the question also, you can also, for in interest of other investors, can you also tell what is the objective of multi-asset fund?
Absolutely. So if you look at what we are trying to create in the multi-asset fund, is trying to give you a market-linked liquid alternative for your fixed deposits, basically. So fixed deposit, as we all know, have been a losing proposition for investors. One, there is an absolute element of tax, which kind of gets deducted whenever you receive an interest payment, which is usually quarterly. Also, if you see the returns from FDs, they have lagged inflation at most times, at least the real rate of inflation that we have seen on the consumption basket. That makes it a real losing proposition. What we are trying to do in the multi-asset fund is to take minimal risk, combine asset classes in such a way that you end up taking slightly higher risk than what you would do in a fixed deposit, but yet on a higher return than your fixed deposit, which is closer to the inflation level. So at a real rate, you are kind of at least closer to not losing money on a real basis. Whereas FDs are losing, and the track record speaks for itself. As Ajit alluded before, more than 90% of the time on a 3-year rolling basis, the multi-asset fund has done better than the SBI 1-year fixed deposit, which is rolled over year on year if you had a 1-year deposit put in. So that tells you that, the market linked alternative has given better returns. If you look at, as most investors would say that, risk is the ups and downs movement. So the standard deviation of the fund since inception has been closer to only 6%, which is very low standard deviation. To put it in perspective, equity standard deviation is somewhere between 15 and 20%, whereas this fund had a standard deviation of 6%. Plus, on the fixed deposit, we have seen so many cases where banks have gone belly up or have become bankrupt, or there have been liquidity problems where investor money got stuck in certain banks. Whereas here it's a market-linked liquid alternative where you can redeem on any given day. So I think this is a far better alternative than going for fixed deposits. I think it's time that investors move away from that, fixed deposit, which has been a losing proposition, to something like a multi-asset, where they end up taking higher risk, but are rewarded for taking that higher risk and a return which is respectable in light of inflation. So overall, I think it's high time that bulk of money that sits in FDs moves into this kind of market-linked alternative, so that investors can do justice to their hard-earned money and get a better return.
Thanks, Chirag. Chirag, there's a question on FIIs. Do you see FIIs resume buying Indian companies again?
Yeah, so I think we've seen this week, over last 2-3 days, we have seen some buying interest come in, and FII has been on the buying side, as against they have been sellers for last 7-8 months. Since October of last year, we have seen a relentless selling by foreign institutional investors. If you look at global markets or emerging markets, India offers a higher real GDP growth rate as compared to most other emerging markets, or even developed markets. If you look at stability from that perspective, India is reasonably stable as compared to the likes of maybe China or Russia. India is far more stable from a relative perspective. India growth story looks poised well. If you look at the levers that we are seeing in the economy, are similar to what we saw in the 2003-2007 phase, where India grew significantly. Even at that time, we had inflationary pressures in the economy, but still India managed to do well during that phase. We are seeing similar levers of growth this time around. So overall, one important element that was leading to that FII outflows was increase in interest rates in the US market, which was sending or leaving money from emerging markets and going back to home market in the US. But at some point in time, they will come back chasing growth, and India looks better poised to get an allocation given the growth profile that we are seeing today in the economy. So overall, I think there is likely to be that return of that foreign investor in Indian markets sooner rather than later. One more element that was having pull out from India, because India was relatively highly valued as compared to many other emerging market economies. So there was some rebalancing going on from these foreign investors, also leading to outflows. But I think now, given the correction in Indian markets also that we have seen, the relative valuation gap has narrowed, and therefore, again, a reason for FII money to come back to Indian markets. So overall, we are hopeful that Indian FII buying should resume sooner in Indian markets, and if last 2-3 days could be an evidence of that turning point.
Thanks, Chirag. There are some more questions on the global fund that we are going to launch, but we would like to answer. We would like to take all those questions. We really appreciate the interest that you have shown, all of you have shown in that fund. But once the product comes through from the regulator, we'll be able to give you all details. Chirag, there's another question which you answered on the succession plan. That's an extension of that question from the same investor, from Mr. Pramod. He's asking that it's not a longevity concern, it's not from the fund house aspect, or not from our process driven approach, or that we do not believe in a star fund manager. What he's asking is, the fund house, normally all AMCs seem to be backed up by a bank or something. Yeah. So how do you see Quantum Mutual Fund as an ED?
So overall, if you see that, whenever they are backed up by like an institution like bank, they have that reach of that investor base or a customer base that they can, reach out with their offerings. So overall, if you look at, we are not backed by a bank or any other institution. We reach out to investors on our own. And given the approach that we have in terms of having investors buy our product rather than we selling them the product, has a longer horizon. But we want investors to be convinced, know what they are getting into, and then buy into our products. So overall, we think that it's going to be a longer term approach, and we are ready to grind that long-term road and ensure that we have investors who know us, know what they're investing into, understand that, and complete their investment journey with us. So we know it's a long road. We are ready to fight that battle, and also ensure that while we are doing right for the investor, we will keep growing at regular intervals and reach that milestones that we have to reach. So I don't think that's an issue. Overall, if you see despite the low capital, we have been there since 2006. The parent Quantum Advisors manages money for many foreign investors, and therefore has their revenue base coming from there, and that supports the Quantum Mutual Fund. And so from that standpoint, there are no issues from a Quantum Group perspective. But we will ensure that we will do the right things for investors, and at some point in time we will hit that growth curve and ensure that we grow as well as while we do good for investors. Thanks,
Chirag. There's another question. It's the customer wants to reconfirm it again. Whether Nifty the new fund Nifty FOF will be taxed as an equity fund. Yes, it will be taxed as an equity fund, even though it lies under fund of fund. Hitendra, would you like to comment on that?
No, it's fine. It will be taxed like just other equity funds.
Yes, it will be taxed as an equity fund only, even though it is a fund of fund, because underlying assets are completely into equity. So thanks Chirag, thanks Hitendra. Just before would like to have your closing comments also, and there is one more question for you, Chirag. I think this question will never leave you in any webinar. Why not silver ETFs?
So I think we were looking at gold and silver, and from that perspective, if you look at silver as a commodity, post getting delinked as a form of money, the bulk of the usage for silver is for industrial purposes. So whenever it is, so from that standpoint, if it is used for industrial purposes, the demand for that commodity increases when the economy is doing well, and therefore it has a very strong linkage to economic growth. your equity allocation also gives you that linkage to the economic growth, because equities will do well when economy is doing well. So both give you a similar kind of linkage to economic growth. And therefore, we have seen time and again, when equities do well, commodities, industrial commodities like silver, copper, etc., do well. And therefore, they do not help you diversify your portfolio exposure. Whereas the levers for gold or drivers for gold are very, very different. And therefore, it is an excellent portfolio diversifier as against silver, which is not a great diversifier. So from that standpoint, I think from a portfolio allocation, you should stay with gold and not try to venture into silver, although it is touted as cheaper cousin of gold, but it has not been as good as gold. So stay with silver. Time and again, we have seen different episodes. Take 2020, for example, when COVID year, when equities fell, silver also fell sharply, gold held initially and then went up. Whereas silver didn't do as well as what gold did. So from stats standpoint, there are enough evidence that tells you that gold is a great diversifier as not silver. Silver is half copper, half gold. So it kind of lingers. It is like it has not done well when copper has done well. So it has traded copper returns, and it has not even done well when gold has done well. So during bull markets in gold, silver has trailed gold as well. So from that standpoint, it is nowhere, and therefore languishes between both gold and copper. So you need to pick what you're investing for. If it is diversification, you have to be with gold. And when it comes to silver as a commodity, there are many spin stories that we hear that it is used in solar related stuff. It is used in EVs. It is used in many other things that are the new generation stuff or green stuff. But you should remember that the usage of silver in solar panels has over a period of time reduced to 1/10 than what it was earlier. Even as a commodity is higher priced, it is prone to substitution by cheaper commodities or efficient use of commodities, and therefore it is prone to those declines. So don't fall prey to those spin stories, and try to be with gold. It is time tested and it helps you diversify, and 80% of into equities will help you ensure that it's on a growth path and create wealth for you. So that 20-80 allocation to gold and equities works well, rather than diverging into things like silver.
Thanks, Chirag. So Chirag and Hitendra would like to have some closing comments from you before we sign off for the day.
Thank you all for listening us very peacefully and giving your queries. And I think that we are able to clarify whatever questions you have. And we hope from you that you are satisfied with our presentations. Thanks.
Thank you. Chirag?
The only thing I'll reiterate is that you need to diversify, build an asset allocation framework, no matter how you want to build it within those large buckets of gold, equity, safe money. You could do it that way, but it is necessary to asset allocate. Start with that asset allocation and build it with things that you have preference for or you think will help you achieve your financial goals. So please remember the 12, 20, 80. You could use our website and you could see how it has functioned before. You can change your allocations and see how it could have performed, and take that guidance to build your own asset allocation. So this is a suggested allocation. You can change it to your own circumstances, to your own convenience, to your own beliefs. But it is important to asset allocate. So please do asset allocate. If you believe in a passive asset allocation strategy, then core could be the Nifty 50 ETF fund of fund as a core allocation. So no matter the way you want it, the underlying message stays the same. Please diversify and build an asset allocation framework.
Thank you, Chirag. Thanks, Hitendra. Thanks, Ajit. It was a pleasure listening to you today also. Thanks all. Thank you all investors. Any more questions if you have for Chirag, Hitendra, for us, you can write us at customercare@quantumemc.com. We'll be very happy to answer your questions. Anything you would like to ask us, you can always write to us. Thanks a lot. Thanks, Chirag. Thanks,
Yes,
Hitendra.
Sandeep. Thanks, Chirag. Thanks, Hiten, and thanks to everyone for patiently listening. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.